All friends, good morning. Jayendra Rana here. The topic of the day is simplifying the insurance operations in India. Simplifying the insurance operations in India. Say, the government is expected to introduce a bill to amend the Insurance Act 1938 during the next session, aiming to achieve insurance for all by 2047. So some of the provisions which could be part of the amendment bill include composite license, differential capital, reduction in solvency norms, issuing captive license, change in investment regulations, one-time registration for intermediaries, and allowing insurers to distribute other financial products. Then, what will change? That is an important question. Because the move will enable the entry of differentiated insurance companies like in the banking sector. The banking sector is currently categorized as universal bank, small finance bank, and payment bank. So the provision of composite licenses would allow life insurers to underwrite health insurance or general insurance policies. Now, what is this Insurance Act 1938? As per the provisions of Insurance Act 1938, life insurers can only offer life insurance covers while general insurers can offer non-insurance products like health, motor, fire, marine, etc. So the IRDAI does not allow composite licensing for insurance companies, which means that an insurance company cannot offer both life and non-life insurance products as one entity. So the draft bill is ready and it has to go to the cabinet for its approval. So the proposed amendments primarily focus on enhancing the policyholders' interest, improving returns to the policyholders, facilitating the entry of more players, leading to economic growth and employment generations, enhancing efficiencies of the insurance industry, operational as well as financial, and enabling ease of doing business. So, let us understand the background of it. The Finance Ministry in December 22 invited comments on the proposed amendment to the Insurance Act 1938 and the Insurance Regulatory Development Act 1999. So the Insurance Act 1938 serves as the principal act to provide the legislative framework for insurance in India. It provides the framework for the functioning of insurance businesses and regulates the relationships between an insurer, its policyholders, shareholders, and the regulator, that is Insurance Regulatory and Development Authority of India. So the easing of capital norms can allow the entry of companies focused on microinsurance, agriculture insurance, or insurance firms with a regional approach. The entry of more players in the sector would not only push penetration but result in greater job creation across India. Currently, there are 25 life insurance companies and 32 non-life or general insurance firms in India. These also include companies like the Agriculture Insurance Company and the Export Credit Guarantee Corporations Limited. Now the question is, this Insurance Regulatory and Development Authority of India has circulated on exposure draft of the IRDAI registration capital structure, transfer of shares and amalgamation of Indian insurance companies regulation 2024 with the aim of streamlining the insurers registration process, facilitating share transfers and other capital related transactions, promoting insurers amalgamations, facilitating the listing of insurers share on stock exchanges, and fostering a business friendly environment. So, taking one of the significant compliance burden for stakeholders and with the objective of simplifying the scattered regulatory framework, the IRDAI has circulated the consolidated draft regulations based on the inputs from a regulations review committee constituted for this purpose. Now the consolidation draft regulations brings together and harmonize the provisions of 7 different regulations issued over a decade. And these are the IRDA Registration of Indian Insurance Companies Regulations 2022, the IRDA Other Forms of Capital Regulations 2022, the IRDA Manner of Assessment of Compensation to Stakeholders or Members on Amalgamation Regulations 2021, the IRDA Issuance of Capital by Indian Insurance Companies Transacting Other than Life Insurance Business Regulations 2015, the IRDA Issuance of Capital by Indian Insurance Companies Transacting Life Insurance Businesses Regulations 2015, the IRDA Scheme of Amalgamation and Transfer of Life Insurance Business Regulations 2013, and the IRDA Schemes of Amalgamation and Transfer of General Insurance Business Regulations 2011. Although the consolidated draft regulations do not introduce sweeping changes, a few key modifications can be seen. Like key changes proposed are approval for listing of shares. So the listing of shares of an insurance company previously required the prior approval of the IRDAI. The consolidated draft regulations do away with this approval requirement, and an insurance company can now directly approach any financial sector regulator for listing its equity shares subject to the fulfillment of certain criteria, including the listing being in the interest of the policyholders, filing an intimation with the IRDAI, and the insurer being able to comply with the regulatory stipulations of the financial sector regulations or financial sector regulators. Then the relaxation of lock-in period. While investments in the shares of an insurance company in the capacity of an investor or promoter continues to remain subject to the previously prescribed lock-in periods, the consolidated draft regulations permit the IRDAI to relax these lock-in requirements in cases where the insurance company is seeking to list shares on a stock exchange in India, the insurer or shareholder is in a distressed financial position, or the insurer or shareholder is engaged in an amalgamation, or the relaxation grants greater flexibility to insurance companies and investors alike. And this action of the IRDAI will be positive as it will help in alleviating the solvency issues that some insurance companies have faced. Then the approval for transfer. So the consolidated draft regulations also provide that any investor whose aggregate holding is 5% or more of the paid up equity share capital of the insurance company does not require the prior approval of the IRDAI for further occupations of share up to 10% of the paid up equity share capital of such insurance company. And the nomination of directors, the previous regulatory regime permitted investors to invest in up to two insurers operating in the same class of insurance business and permitted such investor to nominate a director to the board of the insurance company in which its shareholding exceeded 10%. However, in order to avoid a possible conflict of interest, the consolidation draft regulations clarify that an investor holding shares exceeding 10% on the paid up equity share capital in two insurers operating in the same class of insurance business can only nominate a director to the board of any one of the two insurers. So, with the insurance sector being given a significant push and the insurance landscape in India being prioritized as a matter of policy, the consolidated draft regulations make a significant step towards introducing flexibility to this pivotal sector and will promote greater investments. Thank you. Thank you very much.